Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today we are going to discuss three very important news articles, three very important RBI articles. So here we are going to discuss about the sources of variation in the India's foreign exchange reserves for the financial year April 2025 to March 2026. So the data has been provided for the complete financial year. The data we will discuss regarding the balance of payment as well as for the foreign exchange reserves. Okay, the same data is also mentioned in the financial stability report of uh, June 2026 edition. So if you just focus on the data here, it will become easier for you to cover it in the FSR also. Okay, so here you can understand that the data is important because it was released in the RBI website, in the RBI press releases. The sources of variation in India's foreign exchange reserves, the change in the foreign exchange reserves in the financial year April to March 2025-26, and the balance of payment data has also been given, which is also mentioned in the financial stability report, which is a very important report of the RBI. Okay. Next article is regarding the Reserve Bank of India Prudential Norms on Capital Adequacy Amendment Directions, where we will discuss about the risk weight that has been provided for a new kind of exposure, okay, or guaranteed exposure. Then the last article that we are going to discuss is regarding the Reserve Bank of India Interest Rate on Deposits Amendment Directions 2026. There are some changes that has happened regarding the FCNR, NRE, NRO deposits, so that we are going to discuss. So these three articles of RBI we are going to discuss in today's Finance 360-degree session, and these three articles are very important from your phase 2 of the RBI Grade B examination from the objective point of view, okay. So good morning everyone. Good morning Avnish. First, do tell me if I am clearly audible and everything is fine. The screen is clearly visible. Objective point of view. Okay, just give me a thumbs up if everything is fine. Chalo. Now, let's start with the first article, that is the sources of variation in India's foreign exchange reserves during April to March 2025-26. Okay. So for 2025-26, that is for the financial year 2025-26, the RBI has released the data on sources of variation in India's foreign exchange reserves, how much the foreign exchange reserves have increased or decreased. So what is the change that has happened in the foreign exchange reserves for the 2025-26 financial year after releasing the balance of payment data? So after the balance of payment data was released for the fourth quarter, that is the last quarter in the financial year 2025-26, the last quarter is the fourth quarter from the Jan to March. From the Jan to March 2026. Okay, so this is the idea. And for the full balance of payment, the full balance of payment data was also released for 2025-26. So balance of payment data was released for the last fourth quarter, that is from Jan to March 2026. And with that, the full balance of payment data was also released for the financial year 2025-26. So this is the idea. Now, with the release of the balance of payment data, there is the the foreign exchange reserve data that has also been released. So let's understand this, that what is the balance of payment data and how is it showing the change in the foreign exchange reserves. So current account, see, in the balance of payment, what is balance of payment? Balance of payment records and summarizes all the economic transactions that India is doing with the rest of the world. So all the economic transactions that we are doing with the rest of the world, that India is doing with the other countries, that is recorded under the balance of payment. So balance of payment has two accounts, the current account and the capital account. In the current account, there is trade in goods, there is trade in services, there is transfer payment. Okay, so in the current account, there is the regular transactions that happen between the countries, the trade in goods, the trade in services, the transfer payments, that is the internal remittances or outward remittances. So the remittances, gifts, they come under transfer payment. Okay, so current account includes the trade in goods, the trade in services and the transfer payment, and India receives a lot of internal remittances. Okay, so the transfer payment is usually in surplus, the trade in services is in surplus, but the trade in goods is in deficit, and the trade in goods deficit is larger than the surplus in trade in services and transfer payments. That's why the current account, the current account is in deficit, and the deficit of current account has increased from $23.1 billion to $25.4 billion. So in 2025-26, that is in the past financial year, the current account deficit was $25.4 billion. Okay, so this was the current account deficit. Now coming to the capital account. Capital account, what is included in the capital account? So capital account, it includes the investments that we are doing in the other country, that we are getting from the other country. So we are getting the foreign portfolio investment, we are getting the foreign direct investment, we are also doing the FDI or the FPI in other countries. So the investment, this is the economic transactions between the countries, as well as the borrowings. We are taking the external commercial borrowing. The commercial entities of our country take the commercial borrowings, external commercial borrowing, the short-term debt from the other countries and such, as well as there is also the external assistance. So there is external borrowing, external assistance, investments that come under capital account. Okay, that come under capital account. So capital account includes the investment, the foreign direct investment, the foreign portfolio investment. It includes the borrowings, the external commercial borrowings, the short-term debt, even the deposits. They are also the liability that the bank has to return, because the bank is taking the NRI deposits, the bank are taking the deposits from the non-resident Indians. The bank has the obligation to return the money. So that is the liability for the bank. So the investment, borrowing, and the external assistance, it comes under capital account. Now the capital account, it was in surplus in the 2025-26 financial year, but the surplus has reduced from $18 billion to only $1.8 billion. So here you can understand that the current account, see in the balance of payment, there is the current account and capital account. Current account, trade in goods, trade in services, and transfer payment. Remember that the trade in goods is also known as visible trade or the balance of trade, while the trade in services and transfer payments, they are collectively known as invisibles. Okay? In the capital account, you have investment, external borrowing, and the external assistance. So now the current account is in deficit. The current account is in deficit of $25.4 billion, while the capital account is in surplus of $1.8 billion. So what is the balance of payment situation? Is it in surplus or deficit? The balance of payment is in deficit. The balance of payment is in deficit of how much? So balance of payment is in deficit of $23.6 billion. The balance of payment is in deficit of $23.6 billion. Okay. So here, with the deficit of balance of payment $23.6 billion, how can we cover this balance of payment deficit? So basically, the RBI provides the foreign exchange reserves to cover this balance of payment deficit. Because if the balance of payment is in negative, we have to make the overall balance of payment zero, because the balance of payment shows the transactions between India and the rest of the world. So it cannot be negative, because if there is any deficit, that means there are the payments pending from India's side. So we have to cover that up. So RBI provides the foreign exchange reserves. So RBI provides $23.6 billion of foreign exchange reserves to make the balance of payment situation zero. So that means we have paid all the payments that we had to do. Okay, so all the money that we had to pay, we have paid it. So the foreign exchange reserves were used $23.6 billion. That means the foreign exchange reserves reduced by $23.6 billion. Okay, so this is the situation. On a balance of payment basis, we are not seeing the valuation effect, we are not seeing the other effects right now, only on the balance of payment basis, on the basis of the transactions between India and the rest of the world. Foreign exchange reserves decreased by $23.6 billion. So foreign exchange reserves decreased by $23.6 billion. Okay. Now this is higher than the depletion of foreign exchange reserves in the 2024-25, where the foreign exchange reserves only decreased by $5 billion. So remember that in the 2024-25, in the like past to past financial year, the foreign exchange reserves only decreased by $5 billion, but in 2025-26, the foreign exchange reserves decreased by $23.6 billion. Now, what is this valuation effect? How does it affect? So that we will discuss. Okay. Now, the valuation gain. What happened that in the foreign exchange reserves? What do RBI keep in the foreign exchange reserves? In the foreign exchange reserves, RBI has foreign currency asset, that is dollar, pound sterling, Japanese yen, the euro, etc. Okay. So in the foreign exchange reserves, the RBI is keeping the foreign currency asset, the foreign currency. Okay. RBI is also keeping gold, and the gold prices are continuously increasing. Okay, there was a rapid increase in the gold prices from 2025 to 2026. In this financial year, the gold prices rapidly increased. There is also the special drawing rights that is kept in the foreign exchange reserves. The special drawing rights are the rights that is given by the, this is the international asset given by the IMF. Okay, so the member countries, we have to provide some quota to the IMF, and the IMF provides the special drawing right, that it's the international asset, to the member country. So we have provided, India is a member of IMF, so we have provided quota to IMF. IMF provides SDRs to us. Okay, there is also the reserve tranche position that we get from the IMF. This is the reserve position for India. Okay. So now what happened that the gold prices were increasing continuously, due to which the foreign exchange reserves, their value increased, as well as the dollar was depreciating against the other strong currencies. So that means the reserves that we have of the other strong currencies, they started to appreciate. The dollar was depreciating against the other strong currencies. So other strong currencies, if the dollar is depreciating against the other strong currencies, okay, so that means the other strong currencies are appreciating against dollars. So this was happening that the valuation, there was a valuation gain in the foreign exchange reserves. There was a valuation gain primarily reflecting the higher price of gold and the depreciation of dollars against major currencies. So if the dollar is depreciating against major currencies, that means major currencies, other major currencies, they are appreciating. Their value is increasing against the dollars. So foreign exchange reserves, the value increased, or there was the valuation gain because of the higher prices of gold, because of the depreciation of dollars against the other major currencies, due to which the valuation gain was of, the valuation gain in the foreign exchange reserves, the valuation gain was of $46.4 billion in 2025-26. So here you can understand that the valuation change in foreign exchange reserve, or the valuation gain in the foreign exchange reserve, was of $46.4 billion. That is nearly like 80% higher than the previous financial year. So in 2024-25, the valuation gain was only $26.9 billion, while in 2025-26, the good thing is that the valuation gain was of $46.4 billion. Now, what is happening that the foreign exchange reserves declined because of balance of payment situation. Because of balance of payment situation, the foreign exchange reserves declined by $23.6 billion. This is the balance of payment situation, that the foreign exchange reserves declined by $23.6 billion. While because of the valuation gain, the foreign exchange reserves increased by $46.4 billion. Okay? $46.4 billion. So what is the actual change in the foreign exchange reserves? That you can see, $22.8 billion. This is the actual change in the foreign exchange reserves after taking the valuation gain in account. I hope this is very much clear. I hope this is very much clear that the valuation gain is $46.4 billion, while the so valuation gain in foreign exchange reserve, the foreign exchange reserves increased by $46.4 billion because of the valuation gain, because of the increase in prices of gold, because of depreciation of dollars against the other currencies. Now, change in foreign exchange reserves on balance of payment basis was the decrease in foreign exchange reserves by $23.6 billion because of balance of payment deficit. So in total, the total change in reserves is $22.8 billion. This is the total change in the foreign exchange reserves after taking into account the valuation gain and the change in foreign exchange reserves. So this is and these three data points, they are very, very important, that what is the change in foreign exchange reserves because of balance of payment deficit. So balance of payment deficit, the balance of payment deficit, it is how much? Okay. So due to that, the foreign exchange reserves change is how much because of balance of payment deficit basis. What is the valuation gain in the foreign exchange reserves, and then what is the final change? Okay. So balance of payment deficit is $23.6 billion, while the valuation gain is $46.4 billion. Okay. That's why the final change in foreign exchange reserves is $22.8 billion. So these are the three data points that are a must for you to remember. Now there is also about the investment, the data is given, like the foreign direct investment. So the foreign direct investment and such data is given that you can read once because these are the yearly data that are usually considered important. So foreign direct investment increased, the portfolio investment, it decreased massively. So you can understand that the portfolio investment in India decreased. Portfolio investment means the investment that is happening in the financial market of our country. So the portfolio investment, it has substantially decreased. So this is the problem, that the portfolio investment, the investment by the foreign investors is decreasing in the financial market. Chalo. The external commercial borrowings, this also has decreased. Like before we were borrowing more, but now we are not borrowing as much. Okay. And recently RBI tried to boost the external commercial borrowing also. Like by providing a swap facility that we have discussed, that there is a swap facility for the external commercial borrowings. Now, coming to the next article. So basically in April 2026, the RBI released the directions for the commercial banks regarding the capital charge for credit risk. So before the banks, they themselves used to decide that what should be the risk weight. Okay. So before, the banks, they used to decide the risk weight on the basis of the ratings, the credit rating. According to the internal policy, the banks used to decide the risk weight, that a particular borrower has the risk of 80% or 50% or 20% or 0% or 10%. So what is the risk weight for a particular borrower? So that was decided by the internal policy of the bank. But now RBI has said that RBI has provided a standardized framework where all the banks have to follow the risk weights provided by the RBI for the different loans, So this was released in April 2026, that from 1st April 2027, this standardized approach will be followed for deciding the risk weight for the loans that are provided by the banks. So this was the idea. Okay. Now, there is some update that has happened in the risk weight that we will understand. So earlier RBI released the Reserve Bank of India Commercial Bank Capital Charge for Credit Risk Standardized Approach Direction 2026, where under those direction we studied how risk weight are assigned to different type of bank exposures by the RBI. RBI decides the risk weight for the different kind of bank exposures, both fund-based, non-fund based claims on the central government. See, the fund based and non-fund based, that means even if the central government is taking loans, or the central government is taking any kind of borrowings, or the central government is taking any kind of overdraft facility, or the central government is providing any guarantees and such. So all of this, like the central government, the banks exposure to central government shall attract a 0% risk weight, because it is said that if the banks are providing funds to the central government, so here there is no risk. So there should be 0% of the risk weight. Okay. So central government, if the claims are on the central government, if the exposure are on the central government, the risk weight will be 0%, as well as for the central government guaranteed claims. If the central government is guaranteeing some exposures, they shall also attract a 0% risk weight. So if the banks are funding the central government, if the banks are providing the facility to the central government, the credit facility to the central government, so in this case there will be 0% of the risk weight. But in the case where the bank is, let's say, providing some credit facility to some XYZ entity, and the central government is guaranteeing this claim, guaranteeing this loan. So in this case also the risk weight will be 0%. Okay. So the central government backing, whenever it is there, there will be risk weight of 0%. Now the risk weight of 0% will also be applicable for exposures for the credit facilities that are guaranteed under any of the existing or future schemes under the Credit Guarantee Fund Trust for Micro and Small Enterprise. Okay. So basically there will be the risk weight of 0%. This shall be applicable for the credit facilities that are guaranteed under these, under the Credit Guarantee Fund Trust for Micro and Small Enterprise, under the Risk Guarantee Fund Trust for Low Income Housing, as well as the individual schemes under the National Credit Guarantee Trustee Company Limited, which are backed by an unconditional and irrevocable guarantee provided by Government of India. So it has been clearly laid down that if the bank is having an exposure to the central government, there should be a risk weight of 0%. If the bank is having the exposure to other entity that is having the guarantee from the central government, but this loan, this exposure is having the guarantee from the central government, so risk weight should be 0%. As well as if the bank is having the exposure, the credit facilities to any entity where the guarantee is provided, through the individual scheme under the GTC, which are backed by an unconditional irrevocable guarantee provided by the Government of India, or which are getting the guarantee. So the guarantee for this exposure, for this credit facility, the guarantee is provided by the CGTMSE or the CRGFTLIH. So this is the idea that here also the risk weight will be 0% because the exposure has the guarantee from these trusts. Now, the claims on the Export Credit Guarantee Corporation, that is the claims on the ECGC, shall attract a risk weight of 20%. Okay, so this is the idea. Any confusion till now? Clear? Now RBI, now what's new? This was given in the capital charge directions that were released in April 2026 that we have discussed during the marathon sessions also in detail. Okay. Now what is new? What has changed? So RBI has now clarified the risk weight treatment for the exposures guaranteed under the Emergency Credit Line Guarantee Scheme. So the NCGTC, it has brought forward ECLGS 5.0. So we are pleased to inform you. So this was by the NCGTC. This article was released that we are pleased to inform you that the Government of India through the Ministry of Finance, Department of Financial Services has introduced the Emergency Credit Line Guarantee Scheme 5.0. Okay. This scheme provides credit guarantee coverage of 100% for MSMEs. So credit guarantee coverage is 100% for the MSMEs. So the scheme provides credit guarantee coverage of 100% of the exposure to the MSME. So if MSME is getting the loan of 1 crore, so 100% of guarantee is provided by the ECGC. So this is the idea. Clear? So this is the idea that if 1 crore is the exposure, to the MSMEs by the banks, so here 100% of guarantee is provided by the ECGC and 90% for the non-MSMEs as well as airline sector to member lending institutions. So this scheme provides credit guarantee coverage of 100% for the MSMEs. The guarantee is 100% for the MSMEs and 90% for the non-MSME as well as airline sector. This guarantee is provided to the member lending institutions for the default amount under additional credit facilities extended to eligible borrowers. So this is the idea. So the salient objective of the scheme is introduced as a targeted response to the exceptional circumstances caused by the West Asia crisis. Because of the West Asia crisis, the problems are coming. It aims to support borrowers by encouraging the member lending institutions to provide additional working capital, term loans for business continuity and stability. And under this scheme, there is the guarantee that is provided under the ECLGS under the ECLGS, there is the guarantee that is provided 100% for the exposure to the MSMEs and 90% for the non-MSME as well as airline sector. For whatever default amount is there, there is 100% guarantee or there is 90% guarantee. Okay? So this is the idea. So exposures guaranteed under the ECLGS 5.0 shall attract the risk weight of 0% to the extent of 75% of the guaranteed portion. So if 1 crore is guaranteed by the ECLGS, so 75% of that, that means 75 lakhs, should have the risk weight. This much exposure should have the risk weight of 0%, and the rest of the rest of the exposure of 25 lakh should have the risk weight as per the applicable guidelines under the capital charge. For the MSMEs, the risk weight can be 75%, 85%, 150% on the basis of the different criteria. Okay? So exposures guaranteed, the exposures guaranteed under the ECLGS 5.0 shall attract a risk weight of 0% to the extent of 75% of the guaranteed portion, that is to the extent of guaranteed portion wherein the settlement amount is expected to be received within 30 days from the date of invocation. So the guaranteed portion, where the 75% of the guaranteed portion is that portion wherein the settlement amount, the bank will get the settlement amount, the member lending institution will get the settlement amount within 30 days from the date of invocation. There is some problem that is coming in the video or everything is fine? Chalo. So I hope this is very much clear that first of all, under the ECLGS, there is 100% of the guarantee that is provided for the default amount for the MSMEs, while for the non-MSMEs and airline sector, there is the 90% of the guarantee that is provided, out of which it is said that 75% of the guaranteed portion will have the risk weight of 0%. That is all. Okay? So this is the idea. That 75% of the guaranteed portion has the risk weight of 0%. 75% of the guaranteed portion has the risk weight of 0%. And here the settlement amount, so let's say if the guarantee is revoked, that means the default has happened and the guarantee is revoked, so within 30 days the settlement amount has to be paid. Okay? So the settlement amount is expected to be received within 30 days from the date of invocation. So the remaining exposure will not get the benefit of 0% risk weight. The remaining amount will attract, the remaining exposure will attract the risk weight. The remaining exposure will attract the risk weight as per the existing applicable guidelines. So this is the idea. Here the infographic is also given that I hope you can read clearly and you can use this to revise. 0% risk weight applies only to 75% of the guaranteed portion. The remaining exposure, 25% of the guaranteed plus unguaranteed portion, this has the risk weight on the basis of the applicable guidelines. So the unguaranteed portion or the 25% of the guaranteed portion has the risk weight on the basis of the existing applicable guidelines. For the MSMEs, the risk weight can be 75%, 85%, 150% on the basis of the different criteria. So the 25% of the guaranteed portion and the unguaranteed portion completely, it will have the risk weight on the basis of the applicable guidelines, while the 75% of the guaranteed portion has the risk weight of 0%. For the ECLGS 5.0, this is the idea. Applicability of the direction: commercial bank, small finance bank, NBFCs, RRBs, urban cooperative bank, all India financial institutions. Now coming to the last direction that we have to discuss, Reserve Bank of India interest rate on deposits amendment directions 2026. So basically recently RBI has announced different measures to attract the foreign currency inflows. Into India. As part of this broader effort, the RBI has now relaxed interest rate restrictions on certain deposits maintained by non-resident Indians in India. So basically the non-resident Indians, they are residing in US, let's say, or they are residing in UK, they are residing in European countries. So the non-resident Indians, they are residing in different countries. They are non-resident Indians. They are residing in other countries. They are working in other countries. Now they deposit certain amount of their money in India also. maybe when they want to come back to India, or when they want to like spend in India and such, they want to invest in India because they have the Indian origins. So they might have some relatives in India, or they might visit India on the regular basis. So they are the non-resident Indians, but they want to deposit their money in India. So for that, there is the non-resident account, the NRE, the non-resident external account, the non-resident ordinary account. There is the FCNR account, the foreign currency non-resident account. So these are the accounts that the NRIs can have in India. Okay. So the banks basically, so the banks can provide the NRE, NRO, FCNR B account to the NRIs, to the non-resident Indians. So the non-resident Indians that are earning in abroad, but they want to deposit their funds in India, a part of their funds in India. Let's say the NRIs, they are earning in abroad, they are earning in dollars, they are earning in euro, they are earning in pound sterling. So they want to deposit their funds, they are depositing their funds in NRE, in the non-resident external account. So here the dollars, euro, pound sterling that the bank is receiving, that is converted into rupees, and the rupees is deposited in the NRE account. Okay. In the NRO account, this is non-resident ordinary account. Let's say this NRI has a house in India, because recently, when this person was 25 years old, he was living in India, he bought a house in India, but as he turned 30 years, he went abroad for 3 to 5 years and such. So he is currently living in abroad, but he has a house in India from which he is earning the rent in rupees. So that money will go to non-resident ordinary account, because the person is non-resident now, but he is earning in rupees and the money is kept in rupees. Okay. Now FCNRB account, this is the money. Let's say the NRI is sending the dollars, euro, pound sterling in this account to deposit in this account. Okay. So this is foreign currency non-resident deposit account, in which the NRI is sending the foreign currency, and this foreign currency will be maintained in the account itself. Okay. So in the NRE account also, what is happening? In the NRE account also, the NRI is sending the foreign currency, but that is converted into rupees, and that rupees is kept by the Indian bank. While in the FCNR account, what is happening? That the foreign currency is being sent by the NRI, that is kept in the foreign currency only in the FCNR deposit account. These are the deposit account for the NRI. In the NRO, the money is earned in India, or the money is received in India, and the money is kept in rupees only. This is the idea. So now what is the change that has been brought to receive more deposits? To receive more deposits in the foreign currency. Basically, RBI wants to increase its foreign exchange reserves, because the foreign exchange reserves depleted by $22.8 billion, including the valuation effect. The foreign exchange reserves have depleted by $22.8 billion. Now the RBI wants to increase the foreign exchange reserves. So RBI want more of the foreign currency to flow in the country, as well as rupees depreciating, very fast against dollars. So RBI want more dollars to be supplied in India, so that there is less price or less value of dollars. As there is more supply of a product, the price of that product, the value of that product decreases. So RBI want more supply of dollars in India, so that the value of dollars decreases and dollar stop appreciating and rupee stop depreciating. Okay? If there is more supply of dollars in India, the rupee will stop depreciating, or the depreciation will reduce. So this is why RBI want more foreign currency to come to India, and to attract more foreign currency from the NRIs. There are some relaxations that are provided to the NRE and the FCNR accounts, because the NRIs, they send the foreign currency to deposit the money in NRE and FCNR account. Even though NRIs are sending foreign currency to deposit in NRE account, the rupee is deposited in NRE account, and the foreign currency is kept by the banks, converting it into rupees. The Indian banks keep the foreign currency, and in the NRE account, the rupee is deposited. In the FCNR, the foreign currency is coming from the NRIs, which is deposited in this account for a time period. Okay? So at least more foreign currency is supplied in the country. So to attract the foreign currency inflows, so that the depreciation of rupees can stop or the depreciation of rupees can reduce, and the RBI has now relaxed interest rate restriction on certain deposits maintained by the NRIs. On a review, RBI has decided to temporarily withdraw interest rate limits on the new FCNR deposits of 3 to 5 year tenure, and restriction on interest rate on NRE deposits are being withdrawn for 3-year and above tenures. That we will discuss. This point we will discuss clearly now. Applicability of the above direction: commercial bank, small finance bank, regional rural bank, local area bank, rural and urban cooperative banks. These banks have to follow the directions. They are receiving the deposits. So now there is the withdrawal of the interest rate ceiling that we will discuss. So interest rates on NRE, NRO deposits shall not be higher than those offered by the bank on comparable domestic rupee term deposit. So on the term deposits, if the bank is providing 7% for the domestic fixed deposits, term deposit means that is for a time period, like the fixed deposit. So for the domestic fixed deposit, if 7% is the interest rate, for the NRI deposits also, the deposits by the NRIs, the interest rate should be same. Okay. So this is the idea, that the interest rate on NRE or NRO account shall not be higher than those offered by the bank on comparable domestic rupee term deposit. NRE deposit account, these are the rupee deposits made by NRIs using their foreign income. Okay. NRO deposit account, these are the rupee deposits mainly used to keep income earned in India. Interest rates on NRE and NRO deposits shall not be higher than those offered by the bank on comparable domestic rupee term deposit. This we have understood. Now what has changed now? The restriction on interest rate. If the domestic FD has an interest rate of 7%, the NRI FD should also have the interest rate of 7% if they are of the same tenure. But now it has been said that this kind of ceiling or this kind of restriction is being removed. The restriction on interest rate offered on fresh NRE deposits. NRE deposits, because these are the non-resident external deposits. This is the foreign currency that is coming into the country. So this is the NRE deposits. For that, the interest rate ceilings are being removed, including the deposits that are renewed upon maturity. So for the fresh NRE deposits, for the deposits that are renewed upon maturity for 3 years and above tenures, for the NRE deposit, for that temporarily the interest rate ceiling, the interest rate limit is being removed. Even now the NRIs can be provided the interest rate of 9%, 10%, okay, 8.5%, 7.5%. So higher interest rate can be provided to the NRIs for their NRE deposit, because the non-resident external deposits, they collect the foreign currency from the foreign currency is coming into the country. Okay. So this is the idea, that the NRE deposits for the NRE, for the non-resident external deposits, where the NRIs send their foreign income that is converted into rupees to kept the deposit, to keep the deposits in NRE. So but the foreign income, the foreign currency is coming into India. Okay. So there is the relaxation that is provided for the NRE deposits, that is the interest rate ceiling has been removed for a time period, that is temporarily, for the NRE deposits that are for the period of 3 year and above, that are for the period of 3 year and above. So NRE deposits, so the NRE deposits, they previously had the interest rate ceiling, they previously had the interest rate ceiling. So the NRE deposits, they previously had the interest rate limit, they shall not be higher than those offered by the bank on the comparable domestic rupee term deposit. But now this kind of restriction has been removed on the interest rate offered on the fresh NRE deposits or the renewed NRE deposits for 3 years. If the NRE deposits are for 3 years and above tenures, that means the non-resident Indian is keeping the money in India for a longer time period, for 3 years and above, and is temporarily. So this interest rate limit is temporarily withdrawn with effect from June 17, 2026, on the day this notification was released for the period until September 30, 2026. So this is the idea that this facility is only temporarily provided, that is the interest rates ceiling or the interest rate restriction has been temporarily removed till September 30th, 2026 from the date of the notification. And this is for the NRE deposits that are the fresh NRE deposits or the renewed upon maturity NRE deposits which are for the tenure of 3 years or more. Okay? This also applies to deposits that are renewed upon maturity. Now, any transfer from NRO accounts to NRE. See, NRO accounts, these are the non-resident ordinary accounts where the earning is in India in rupees and the money is kept in the account in rupees. So here the foreign currency is not involved. So if any transfer is happening from the NRO account to NRE account, they shall not qualify for such exemption because the foreign currency is not involved here. In the NRE account, the foreign currency is converted into rupees to keep that in the NRE account. So foreign currency is coming into the country. So any transfer from the NRO account to NRE account shall not qualify for such exemption. That is, the interest rate ceiling has been removed only for the NRE account for the tenure of the NRE deposits. So interest rate ceiling has been removed for the NRE deposits that are of the tenure of 3 years or above, the fresh NRE deposits or the renewed NRE deposits. Now FCNRB deposit, here the foreign currency deposits are maintained by NRIs in the Indian banks. Their foreign income is kept in the foreign currency form only. Now the FCNRB deposits, because here the foreign currency is coming from the non-resident Indians and the money in the deposit accounts is kept by the banks in the foreign currency only. So FCNRB deposits states that only the term deposits can be under the FCNRB deposits, only the term deposits, that is the deposits for a time period 1 year to less than 3 years, 1 year to less than 3 years, or 3 years and above up to including 5 years. 3 years to 5 years basically. So for period of deposit, as per the period of deposit, there is also a ceiling rate. The interest rate ceiling is provided. More than this interest rate cannot be provided. So for 1 year to less than 3 years kind of deposits, the reference rate for the respective currency, if the deposit is happening, if the foreign currency is dollar, so whatever reference rate is for dollars, that will be taken. If the foreign currency is, let's say, euro, pound sterling, Japanese yen, so whatever is the respective currency, for that, whatever is the overnight reference rate, alternative reference rate, so reference rate will be taken for the respective currency, the reference interest rate will be taken, or the reference rate will be taken for the respective currency, plus 250 basis point, that means 2.5%. So if the overnight alternative reference rate is 5%, plus 2.5% means 7.5%. For the FCNR deposits 3 years and above up to and including 5 years, so for that the reference rate plus for reference rate for the respective currency, let's say it is 5% or let's say it is 7%, plus the 350 basis point. 350 basis point means 3.5%. So here 10.5% will be the interest for these. This is the ceiling. This is the maximum interest that the bank can provide for these deposits. I hope this is very much clear. Okay. Now what has changed now, that the interest rate, see the interest rate ceiling applicable to the fresh FCNRB deposits, that is the overnight alternative reference rate for the respective currency or swap, plus 250 basis point. This was for the FCNRB deposits, the fixed deposit of 1 year to less than 3 years, or the overnight alternative reference rate plus 350 basis point. This was for the FCNRB deposits that are for the 3 years up to 5 years. Okay? So this interest rate ceiling applicable to the fresh FCNRB deposits, including the deposits that are renewed. So the fresh FCNRB deposits or the FCNRB deposits that are renewed upon maturity, if these FCNRB deposits are for 3 years and above up to and including 5-year tenure, that means for these particularly, that are for the longer tenure, so the interest rate ceiling has been removed, has been temporarily withdrawn with effect from the date of the release of this direction for the period until September 30, 2026. So think about it that for the FCNRB deposits, the new fresh FCNRB deposits as well as the FCNRB deposits that are renewed, for them, if they are for the time period of 3 years and above up to 5 years, ठीक है. If these deposits are for 3 years and above up to 5 years, for them the interest rate ceiling has been temporarily removed up till 30 September 2026. So the interest rate ceiling for FCNRB deposits of 1 year to less than 3 years for the shorter time period, the FCNRB deposits, for them the interest rate ceiling shall continue. This is all that we had to discuss. So now again, through this infographic you can do the revision that the RBI has released these amendment directions. Applicability is on the commercial bank, small finance bank, RRB, local area bank, rural and urban cooperative banks. Now previously interest rate ceilings were there on the NRE NRO accounts. The interest rate on NRE NRO deposits could not exceed rates on comparable domestic rupee term deposit, the fixed deposit or the recurring deposit that are for a time period. Okay? For fresh NRE deposits of 3 years and above. Now for only the NRE deposits, for fresh NRE deposits of 3 years and above, as well as for the renewed upon maturity, NRE deposits of 3 years and above, banks may offer rates without the earlier restriction, and this is effective till 30th September only. This is the idea. Okay? But the transfer from NRO to NRE accounts will not qualify because NRO is earned in rupees, is kept in rupees. Next is FCNRB deposits. So FCNRB deposits 1 year to less than 3 year. So FCNRB deposits, they are only in the term deposit way, fixed deposit and the term deposit that are for a time period, they can come under the FCNRB. Okay, so FCNRB deposits only consist of the term deposits that are for a time period. So 1 year to less than 3 years, they have the overnight alternative reference rate, like for the currency or for the swap, plus 250 basis point. So overnight alternative reference rate for the particular currency, whatever is the reference rate, plus 250 basis point, that is 2.5%. That is the maximum interest that can be provided for these FCNRB deposits. But if the FCNRB term deposits, if these FCNRB deposits are for 3 years or more than 3 years and 3 years or more than 3 years but up to 5 years, so overnight alternative reference rate, whatever is the overnight alternative reference rate for the currency, plus 350 basis point. Now this ceiling on the longer duration FCNRB deposits, this ceiling has been removed till September 30, 2026. So ceiling temporarily withdrawn only for fresh FCNRB deposits as well as for the renewed upon maturity FCNRB deposits of 3 years and above up to 5 years. Okay, so this is the idea. All the currencies, for all the currencies. Okay, also applies to deposits renewed on maturity. Okay, ceiling of 1 year to less than 3 years. So for shorter term FCNRB deposits, there is no such facility, there is no such removal of the interest rate ceiling. Okay, now let me show you the questions and you have to answer the questions. These are the homework questions that you have to answer in the comment section below. I hope you will be easily able to answer the question. Okay, so these are the homework questions. Do try to answer them in the comment section below. So which one of the following correctly represents the total increase in the India's foreign exchange reserves, including the valuation effect during 2025-26? So including the valuation effect, what is the total increase or what is the total change in the India's foreign exchange reserves, including the valuation effect? Okay, during 2025-26. So when only valuation effect is asked, then you have to answer accordingly. When there is the balance of payment that is asked, that you have to answer accordingly. If the foreign exchange reserves, the change or the increase in foreign exchange reserves, including valuation effect is asked, that means like the foreign exchange reserves, the change because of balance of payment as well as including valuation effect. So the final one you have to answer. Okay. Now, as per the RBI's capital charge for credit risk and standardized approach directions 2026, claims on which one of the following attract a risk weight of 20%. So risk weight of 20% is on which of the following? Now, prior to the latest RBI relaxation, the interest rate ceiling for FCNRB deposits with a maturity of 3 years and above up to 5 years was which of the following? So I hope you will be easily able to answer the 3 questions. The PDF of the session you will get in the Telegram channel of EduTap. Okay, so the PDF of the session you will get in the Telegram channel of EduTap, and remember the percentages, the data in the first one. The valuation change in forex reserve $46.4 billion. Change in foreign exchange reserves on balance of payment basis only, excluding the valuation effect, $23.6 billion. The total increase or decrease in reserves, including the valuation effect, so 22.8. So here foreign exchange reserves in nominal terms, including the valuation effect, increased by $22.8 billion. So whenever it is written foreign exchange reserves, change in foreign exchange reserves, increase in foreign exchange reserves, including the valuation change, so you have to tell the final one. Okay, so this is the idea. Chalo, if only valuation change is asked, then you can answer this, but including the valuation change means complete. That is the final one. Chalo. Now do try to answer the 3 questions. I hope you will be easily able to answer the questions, and I will also release the shorts with more questions on these articles. Thank you everyone. Thank you for joining. Thank you everyone.